Good evening. If you're logging in from either YouTube or LinkedIn or any other platforms, you are joining us on another GRIP Invest webinar to explain more interesting products on the fixed income side. Today, we are privileged to have with us as a guest Mr. Kishore Lodha, who's been a veteran in the NBFC industry, someone with experience as in finance for over 20 years and experience as a CFO of an NBFC for over 10. Kishore, pleasure to have you.
Thank
It's
you so much, Nikhil.
really looking forward to this conversation. We obviously have been in touch with you and the company that you represent, UGRO, for over a period of time. A lot of the users on our platform have had a chance to experience not only, I'm assuming, the bonds, but I'm hoping a lot of them have also interacted with UGRO potentially as customers to the NBFC. Just to introduce Kishore in a little bit more detail, after a stint with Future Retail, Kishore had stints with SREI, Hinduja Leland Finance, and for the last 2 years with an NBFC called UGRO Capital. We're going to spend time today understanding from Kishore more about corporate bonds, why NBFCs like UGRO are tapping the corporate bond market specifically with retail investors, and the recent performance of UGRO and developments in the NBFC space and how it impacts you as a retail investor. Kishore, let me start by congratulating you and the team for achieving the milestone of 10,000 crore in AUM. It's an incredible milestone. When you are chasing those dreams and you're growing fast, often these milestones passes by and we don't tend to appreciate how meaningful it is. But 10,000 crores, $1 billion under management is really something else. Many NBFCs, different NBFCs use different paths to it, different lending books for it. As an NBFC, you have chosen to build a book on MSME, and there's a lot of information on your website on why you have chosen MSME as a focus. Would love if you can enlighten us a little bit on that choice and how it's impacted certain business decisions.
Thank you, Nikhil, for the nice words. Yeah, it is a really a milestone which we all cherish. But this is just the beginning. We think there are miles to go, and the opportunities is big. On your question that why MSME and why this space itself, when UGRO was started in 2018, we were very clear that we want to be in MSME space. The reason being that MSME till that point of time was quite untapped market. The credit gap was almost 60 lakh crores. And prior to demonetization and GST coming in, there was no way one can assess the income of a MSME borrower. So traditionally, prior to this, what was happening is that most of the lenders who were keen to do MSME lending, they were generally looking at the property value of the underlying customer, and based on the property value, they were giving such loan, which was unscientific and which was creating the volume suppressed, which was making the segment credit starve. Our post 2016 things started changing. 2016 first when demonetization happened, so a lot of formalization of economy happened. Then GST happened when 2017 when GST happened, and the scenario changed for MSME a lot. Because now the incentive of doing business in cash was no longer exist post GST, because most of the product GST is closer to 18%, and whenever people small and MSMEs were doing business in cash, they clearly realized that there is no point losing 18% GST and work in cash to save some amount of tax here and there. So if you see the trend, our economy has grown by average of 5.5% in last 5 years to 7 years, 2017 to 2024. But our GST collection has grown 16% annualized. That means formalization of economy is that to the extent, and what it is resulting into it is a lot of formal data available for MSME segment. Now MSME segment, you have the from GSTN, you can get the turnover data, underlying customers data. Bureaus are much more mature, so you can get a lot of detailed data on bureau, information from bureau. Bank statements are now mandatory, transactions are happening through banks, so through bank statement you get a lot of insight. So underlying MSME customers is getting easier by understanding their cash flows. Hence we chose and this segment, the opportunities is largest in the country. So as you speak, the credit gap is 92 lakh crore, and MSME's contribution in GDP is about 31%. In all advanced economies, it is about 50%. So as we progress, if the country has to progress, if the country has to fulfill the dream of Atmanirbhar Bharat and third largest economy in the world, 5 trillion economy, is all will happen if MSME contribution increases to at least 40% in next 5 to 6 years time. This is where these are all the factors that prompted us to choose MSME. We believe that this is the sunshine sector which can change the fortunes of India. And also the another factor which is important within MSME, which many people don't realize, that it is the second largest job creator in India other than the agriculture sector. So roughly 45 crore people are involved with agriculture, and roughly 12 crore people are involved with MSME. So this kind of job creation this sector does. Agriculture is slowly slowing down because of younger people don't want to get into agriculture, but everyone wants to be an entrepreneur or being a salaried employee. Entrepreneur and salaried, the choice would be that once you become an entrepreneur, you will start small and that make it big, and the MSME is the way. So we believe that we are in the right sector in the right time. So that is why we have chosen this sector.
Yeah, no, you look at reports across, whether it's an IFC report or a World Bank report, which talk about the biggest credit gap in our country, and marry that with the impact that MSME has, clearly an opportunity to solve. Maybe just to help understand what UGRO provides to MSMEs. If I was an MSME, actually GRIP is an MSME by all standards. If I was to an MSME and come to you as UGRO, what am I able to take as a loan? Is it a standard term loan? Can I take a loan against certain assets? If you could give us some purview of that, that would be helpful.
So in UGRO is unique in many ways. So one is that we don't do every segment of MSME. We do only 9 sectors and about 150 subsectors. So light engineering, electrical equipment, chemical, auto component, education, healthcare, hospitality, food processing, and micro enterprises. These are the 9 sectors where we are present. Beyond this 9 sector we don't go, and in each of the sectors also we have subsector limits, like we do education but we do only K-12 schools. We do healthcare but we do only 5 subsectors like dentist, IVF clinic, pharmacy, diagnostic center, and nursing home below 20 beds. This is by design, not by default. It is well researched document which we have created through CRISIL, where we ask them to identify the best sectors in terms of total addressable market and also credit behavior. So these are the 9 sectors in among the 200 MSME sectors which are behaving best in last 40 years in India in terms of credit behavior, and the total addressable market is roughly around 40%. So it creates, so this is where we are, how we choose the sector, and on what an MSME can look from us. So we are complete solution provider for an MSME. So for those MSME who have a free property, cash flows are sound, they can take long tenor loans from us, 10-12 years loans, by mortgaging their properties, provided their cash flow supports the repayment, where we are comfortable with the credit. So we can do a 12-year loans to an MSME up to 5 crore. If the MSME does not have any collateral, if the collateral is already in place with somebody else, so we can do unsecured loans also up to 3 years, up to 50 lakh rupees to the MSME, so which can fulfill the short-term needs for the MSME. We do supply chain financing, so invoice discounting MSME needs. We can do retailer and distributor supply chain financing as well. If the certain kind of machinery if they are buying, like printing and packaging, CNC machine, then solar rooftop, etc., then we can provide financing to them as well. And to some extent we are solving the problem of MSME where probably which are on a different spectrum of risk, where we partner with some of the smaller NBFCs who underwrites them, and they since they don't have liquidity and capital, they come on us for the capital provision, where we provide the entire capital. They do work as sourcing partner for us and collection partner for us. Hence, we provide all kind of solution which an MSME would need. Even we have started 2 years back. We have started a product which we are pushing very hard. Is from tier 3 to tier 6 cities, where small ticket business loan secured by properties. So which is average tenors are 5 to 6 years, and average ticket is about 8 to 10 lakhs. So you have a small property where you want to take some loan and invest that money in your enterprise. We are there. We have 200 branches now across the country, and slowly we will take it up to 400 branches across country. So we are trying to solve all the needs of an MSME who falls within our credit underwriting parameters.
Understood. That's a fairly good, broad breadth of services and segments covered. But I think there's also a lot of focus on which micro segment you want to get to, and there's a lot of data backing it. In fact, I think one of the things that has always come across in everything that I've read about UGRO is the use of technology. And as a new age NBFC, what you talked about with the ability, with the change in the financial infrastructure, I think that's clearly something that UGRO has leveraged. Maybe would love to hear if you can bring out a couple of places where technology has played a really innovative role, either in underwriting or asset management, and that then obviously adds a lot to how the risk gets mitigated for a bondholder.
So UGRO again is quite unique in terms of design. So I would say with my hands on my heart that I have worked in the industry for very long, and the kind of investment that UGRO has done on technology and data science, I have not seen it in my past experiences. Uh, there another thing which is misconceptions, like Nikhil, you talked about technology. We have clearly two divisions. One is technology, other is data science. People use this interchangeably, which is not the correct way of looking at it. Technology, we strongly believe that technology is for process simplification. So if somebody was doing KYC manually, it used to take one day. Now KYC can be done in 3 minutes time, which can be done through technology. But credit decisioning technology has no role to play. Technology here here the only role which comes into play is data science, and I don't think that apart from UGRO there is any other NBFC in India who has a team of data scientists working 24 into 7 on its payroll. From day one, we have about 50 odd data scientists who work on our underwriting model day in and day out. We called it Grow Score, which is based on GST, banking, and bureau. This is our proprietary underwriting model, which has been created by our own data scientist. And they pick. So we take these two data from independent sources. One is GST we take from with the consent of the customer from GSTN, and bureau we take from bureau with the consent of the customer. Bank statement, the customer has the choice, either they can give us hard copies which we scan and then do a Perfios check, and then we do an underwriting on that, use that as a part of our underwriting process, or they can give us access to their net banking and data. So here the data plays a very big role, and whenever we have whatever products we have, our data team has been the pivotal in terms of design of the product, what kind of credit cost it can bring in the lifetime of the product, and they continuously work on it. So with the more and more data which we are generating in house, as well as some data which we take from bureaus, this model is self correcting model, where each day each data that flows into our system, whether it is our own data or data taken from a third party, the model itself improve itself. So this is where is the differentiator, where I don't think that anybody else has this capability to assess the data in that way. Nobody has, and this is a very expensive affair. So all the people are from either Indian Institute of Statistical Science, IIT, IIM, etc. So they have the aspirations to do something well. The cost is also expensive, but which is really help us in terms of creating the portfolio tight and doing good underwriting. So I hope I have answered your question.
Yeah, no, you have, and I think we are fortunate as entrepreneurs, as people building companies, to be building in a time where India has invested in digital infrastructure at a rapid pace and probably ahead of many countries, and to not take advantage of it by putting in layers of either whether it's data sciences or technology, I think it's a miss. And the growth that we are seeing in the NBFC space or the lending space, partially or to a large extent is because of this access, right? To be able to provide digitally underwriting solutions, leveraging data science for faster deployment of loans, I think is very powerful. I think the other component that required, for you to scale to 10,000 crores is obviously capital, right? And I want to move to that. One of the things that always, and Kishore, we get this question all the time, right? Whether it is from our equity investors, whether it's from our users, if UGRO is or an NBFC is growing so fast, they typically have money borrowing lines from largest of financial institutions. I believe you have debt capital from 60 to 70 large banks and larger NBFCs, including someone like an SBI. Why would you raise capital through bond issuances for retail investors? And I have my own answer, but I'd love to hear yours.
So clearly, it is look when you plan for a large AUM or large continued basis, you see through the cycles. So people like you and me have seen enough cycles. We have seen 2008, we have seen 2013, we have seen 2018, then 2020, 2021. So all these large events teach something or the other to us. So what we have realized in our journey that we should never keep all our eggs in one basket. So diversification is the key, because at some point of time some people would be bullish on the segment or the company, some people would be taking a negative view, and if you are putting all your eggs in one basket, then trouble is round the corner. So banks are the largest liquidity provider for NBFC in India. Almost 45% of the liquidity comes from bank. But you have seen in the past, all of us have seen in the past, that how banks behave when something happens. When DHFL ILFS happened, suddenly banks were very very cautious. At those point of time, if somebody had 100% bank loans, they would have struggled. Similarly, we have seen that how there was no moratorium during COVID time for bond repayments, but there was a moratorium on bank payments. So there the bank side helped, but not the capital market side. So you have to design your liability profile in such a way that you can create an all-weather franchise for liability. Also, I would specifically like to, so whether it can be term loan, it can be like in case of UGRO, all the largest DFIs in the world are our lenders. So starting from FMO, ADB, GMO, water equity, and we are adding DFC, some more name we would be adding soon. And then some of the largest lenders like SBI, Canara, Union, etc. But still we take money from even smaller NBFCs as well, who would be whose AUM may be similar of our size. We take money from small finance bank who are a little expensive, but they come with frequent checks. On the same line, we treat our retail investors in the same passion, that they are all weather friends. When they trust a company, it is a continuous source of liquidity. And like you have seen, I don't mind naming some of the companies, like if you look at Muthoot, Manapuram. These guys are in the market raising public NCD for almost 30-40 years, and you have seen the response. Nobody, investors keep flocking to them when they have seen their repayments for 5 cycles, 6 cycles, 7 cycles, 10 cycles. So this is a continuous source of liquidity, and also to be very frank and honest, it creates a visibility. So if you are holding, we don't mind somebody holding an NCD of 10,000 rupees. In terms of overall AUM, it may be very very minuscule, but a house is knowing our name. Which not only helps us in terms of creating brand value for the franchise, but also to some extent it moves people towards participation in equity. We are a listed entity. We always look for larger number of shareholders, more and more public participation. Bond is a good way of reaching out to migration, where if somebody likes an NCD, naturally they will look at the equity shares as well at some point of time. This is where we rely a lot on, though it is expensive, distribution cost is high, we have to sell out a little more in retail NCDs, but still we continuously come at least once or twice every year We wish to create it as a franchise. It is one large source of resource mobilization for us, and it helps us in terms of resources, in terms of marketing, in terms of our capital, in terms of branding. So all inclusive, it is a good product to if you look at it in totality. But if you look at it in isolation, it is an expensive product.
Yeah, absolutely. And the fascination for us is that as a platform, we're able to provide retail investors access to the same credit risk that an SBI, ADB, some of the large institutions you mentioned are taking, but actually the retail investor is getting a better return on the same credit risk than an SBI is getting, because there are different benefits of it. So I think it's such a powerful proposition for retail investors. At the same time, awareness is a big question, and a lot of the corporate bonds that are available in the market are predominantly of NBFCs today. Right? It's an unfortunate reality. I think as the markets develop, you will have more diversity. Um, Kishore, in your view, when retail investors look at bonds of NBFCs, are there 4 or 5 things that you would say are definite things to watch out for, or metrics to look out for to decide whether this is something that they should look at investing? Because understanding the full balance sheet of an NBFC may be challenging. What would you think as looking at this 4 or 5 things given your 20 years of experience?
So I would say that what drives an retail investor towards an NBFC paper is yield, but it is not the correct way of looking at any NBFC with any entity, whether it is NBFC or anything else. If you have to really understand that if it is your hard-earned money, even if you are putting 10,000 rupees, 50,000 rupees, 1 lakh rupees, it is your hard-earned money, and nobody likes to lose any money. So people should do their diligence. And again, to be politically incorrect, it is nobody's game to read the 400 pages of prospectus and make something out of it and then make a decision. So you have to do some broad analysis which does not take too much of time. And if you can see through those 3-4 parameters well, I think one can understand the risk underlying risk in any entity, including NBFC. I think where people don't put much of the focus and attention is the quality of board and quality of management. So people should be very very focused that who are the independent directors, what is their pedigree. It is very simple thing. You go to the website of the company, you would get to know that who are the independent director and what is their pedigree. That makes a lot of statement about the entity itself. Who are the people in the management, what is their background. It is very important to know that who runs the company, and what is their background, where they have worked in the past, are the entities good. Try to communicate what are their feedbacks in the market, which is commonly available. So this is very important to understand that about the board and the management, which is not a very voluminous thing to read or to understand. Second thing I would say that the underwriting process. Most of the defaults in India, which has happened in India, you would see two things which are pretty common. One is large lending, bulky lending, and second is real estate. I would say real estate has done well in last few years, but I would say that wherever the portfolio is not granular, especially in case of NBFCs, you can easily avoid that because you never know that which cycle, in some cycles, which one or two loans can go bad, and then it can jeopardize the entire enterprise. So if the portfolio is granular, the ticket sizes are small, the better the enterprise is. Third is again, people don't put any focus on this, and which is in my view quite important, is to go through the related party transaction. Some of the related party transactions are statutory, like my salary is a related party transaction, it gets disclosed. But if I am working for UGRO or any CFO is working for UGRO, they will get some salary. But other than MD, CFO, CEO, company secretary, or KMP's salary, what kind of related party transactions are happening and how much it contributes to the either turnover or profitability or volume of the business. If it is significant amount, it is clearly a red flag. So avoid entities which has high related party transactions, which are large, which has large impact on balance sheet as well in PNL. It is clearly a red flag. Please avoid them. Fourth, I would say that capital. How much capital the company has and what is the runway. So if company has a 20-30% of growth projections, and if it is sitting on 25% primary capital or 30% or 40% primary capital, then you have to look at from your perspective whether the company will exist in 10 years time. You need not worry. You see that if you are buying for a 2-year bond, if a company is growing at 30% CAGR and if it has a equity of 30%, that means you are relatively safe. You are, even if no further capital comes in, if 5-10% NPA happens in that entity, at 2 years time it is not going to default. It is as simple as that. So looking at the capital of the entity is one of the important criteria where people sometimes look, sometimes they avoid, sometimes they go to smaller entities with 10-11% kind of tier 1 capital, which is permitted by RBI, that if anything about 10% is okay till the time it is 15% overall. But I would urge that if you are not looking at a house backed NBFC, or please look at the capital adequacy and what is the runway. If it is the runway is well within your maturity period, you are relatively safe. Look at the NBFC which are not doing bulky deals in terms of. So these are the 3-4 parameters where you can see, and then you can look at NPA trends in how it has moved. But I would again say that NPA is not the right reflection of the health of NBFC, because in the past we have seen that some of the NBFC have reported very good numbers and suddenly they have collapsed. So that may not be a very good indicator. So rather than look at management, look at related party transaction, look at capital. These are the primary things you should focus on.
That's very interesting. To be honest, I was expecting a lot more financial metrics, but I think some of the things that you have highlighted, which is a combination of both, if I can call it red flags to watch out for, and actually, the point you made on capital, I think capital can address a lot of things that you may not be able to diagnose from a simple look at the balance sheet or the P&L, like for example NPA, etc. And in the event that something goes wrong, capital obviously ends up giving you that buffer to protect. I have a follow-on question on that, but before I ask, just a message for everyone. Wherever platform you're looking at, you'll find a chat box. If there are questions that you'd like to post to Kishore at the end of the webinar, please keep typing them in, and we'll start asking those questions as well. Kishore, coming maybe as a second part of this question, there are two concepts which also are less talked about with the concept of in the context of NBFC and bonds. One is ALM. And a lot of NBFCs that we have seen where there has been struggle is actually on the ALM side. And the second concept which we don't talk about is the protection that covenants in bonds offer to investors. And especially as we're thinking about, we're seeing some of the situations play out in the NBFC space, I think covenants do act as a security. Could you spend a few minutes, explaining in an incredibly simple way that you've done, what these two mean, and how should investors look at them?
So what was your first question?
ALM.
ALM. So again, one of the most important thing for an investor to look at is on financial side is ALM. ALM, one of the major reason of some of the NBFC falling, which we have seen in last several years, is ALM mismanagement. Companies borrow short and lend long. If you look at some of the data points in the past, NBFCs were borrowing as high as 15% from commercial paper. So even small NBFC is having short-term borrowing of 15-20%. Short-term borrowing does not mean accounting short-term borrowing. Accounting short-term borrowing means anything which is maturing below 12 months, which is accounting norm. But in real parlance, if any company is having 10%, 15%, 20% short-term borrowing, especially in form of CP or ICDs, then it is a red flag. If you have to see also the cycle of how their cycles are reflecting in terms of borrowing as well as lending. what is the average maturity of their loans which they are extending to their customer, and average maturity of loans which the company has taken into. So ALMs are generally reported in annual report. Please go through it. One red flag I would say again here is that I have not come across any NBFC in the past who has reported an ALM mismatch. So again, I would say that some of the entities may have played around with it. I have no shame in accepting that I belong to the industry. Everywhere some bad apples would be there. So it though ALM is very good reflection if it is reported correctly, but if it is not reported correctly, I would though it is a public platform, still I would say that it is very hard to believe that every NBFC in India has a ALM, positive ALM.
And Kishore, in the with this issue of reporting, would you say that it's again looking at the capital adequacy that the NBFC has is a measure of protecting yourself?
Yes, that is why I said ki you can some people can look at ALM in a very different way, and look at their inflows of in a very different way, look at their outflows in a very different way. But capital is sacrosanct. That is reported. So you look at the NOF and look at the growth path, how the company is growing. And if say I am growing at 30% or 40%, and if I have 25% capital adequacy, means I am definitely there for next 3-4 years time in the industry, and your bond maturity is 2 years, 3 years, 4 years, then you need not worry about it. But if the capital adequacy is lower, then and also look at in capital adequacy what is tier 1 capital. Don't look at tier 2 capital. Tier 2 capital is just a liability. It is a tool which is given by RBI to somehow manage the overall limits which has been set up by RBI. But always look at tier 1 capital. Tier 2 capital does not indicate, it is a liability which the company will have to repay. So look at tier 1 capital only and see that where it stacks up in terms of, if it is a large promoter who is bringing capital time and again, then lower capital adequacy is fine. If the track record of bringing capital time and again is visible in the balance sheet, if you look at last 2-3 years data, then it is also fine. But if there is no track record of bringing capital in last 2-3 years time, and the capital adequacy is low, growth is there, then it is definitely a red flag.
Perfect. No, that's very helpful. Maybe a minute more on covenants, and then I want to come back, full circle and connect it to UGRO's results. But would love to hear your thoughts on covenants and what you typically see happen in the industry for bonds.
So what has improved? So if all of us are here are maybe investing in bonds or seeing the markets for long, we have earlier there was no platform to know whether the company is breaching a covenant or not, because there was no reporting requirement per se. Now there have been two changes which has happened in recent year. One is on stock exchange itself, where they are creating a repository of covenants and asking companies to fill in the covenant for all their borrowing and report breach if any. So stock exchange are actively taking this task, though it is a humongous task. A lot of papers are outstanding, and they can't verify it obviously, but they would have to rely on the company to see that whatever they are putting it up on public domain on covenants, they are true. I don't think that anybody would fudge it because it is a public document, and any company can come into trouble if they try to do it. So one is that stock exchanges are trying. Second change which has happened for NBFC especially, after 2021 RBI changed the norm. They have clearly articulated, and it has come from MCA as well, that if any covenant breach is there, an annual report you have to report it. So now there is no escape from not reporting a covenant breach, which is quite robust now, and hopefully it will increase the confidence of a lot of lenders. Some of the covenant breach is again subjective. Some of the covenant breach may happen which may not have any financial impact or liquidity or something else on this aspect of the company, but you have to make your own judgment based on the kind of breach it has happened. Say for example, if somebody has put in a condition of 20% capital adequacy as a covenant, and some company ended up with 19.98%, still it is a breach. But it is you are almost there. But if it is 10%, then certainly it is a cause of worry. Also, now SEBI and RBI both are very very particular, especially SEBI in terms of reporting requirements. So if you delay in earlier there was a, Nikhil, you would clearly remember that earlier there was a curation period available for NCD issuances, where people would say that I have 7 days curation period, 30 days curation period. So even if I do breach something or don't pay, I will still not be defaulter if I during the cure period if I make it good. But now such luxuries have been taken away. Now if you don't pay by 3 o'clock, you have to yourself go and declare yourself as defaulter. You don't have choice but to do it. So SEBI is acting as a good platform. I am an advocate, which unfortunately I have not seen many people advocating it. Since I have got this forum, I will again advocate this. You guys, if you agree with me, whenever you speak, get a chance to speak with anybody, please propagate this. I'm a big supporter of in creating an investor protection fund out of NCD issuances. So what my thought on this is that every investor, irrespective of color of the investor, whether it is from a very very large house or very small house, every NCD that is being raised from public investor, there should be a fee, and I think the 10 basis point fee is good enough, and this should go into the investor protection fund, which SEBI should monitor. So every issuances that they should charge 10% annually. So if I am issuing a 5-year bond, I should pay 50 basis point on the quantum raise. And this, if we can create this mechanism, simple mechanism, and if it can create as an insurance product, for my guesstimate suggests that up to 5 lakh rupees of NCD if investor, they will never lose money if this product comes into play. So whatever money comes into this investor protection fund, if any company goes bad, if anybody has investment less than 5 lakh rupees, SEBI simply said should simply pay it off. Like they have created a fund for equity. So when Carby went down, SEBI pays everyone their principal investment amount. So similarly, why it can't be done on bond side? Again, some of you may ask that why a lender like a UGRO or anybody, say for a very large lender, say Tata Capital, why they would agree to sell out 10%, 10 basis point annually? Actually, it will reduce cost. Because in that case, if you are buying a UGRO bond at 10%, and if you know that you have an insurance of up to 5 lakh rupees, you would invest at 9.8% with UGRO, because your risk premium goes down significantly. So my saving or any issuer saving will be much more than 10 basis point if SEBI can come out with this kind of. I think if this change happens, it will be a landmark change in this whole segment of retail NCD and platforms like GRIP and issuers like us and investors like you, because it helps all three of us. When I issue, I get a lower rate because my risk has been protected to my investors by third party, where the investors would come and invest in me at a lower cost. A GRIP can sell a product easily because they know that up to 5 lakh, if anybody is buying, their money is secured. So rather than doing an FD with a bank at 7%, 6%, 7.5%, 2% is definitely an incremental yield that you can get on an NCD. Even if a good quality NCD can give this kind of additional yield compared to FD. I have not seen anybody else propagating it, but whenever I get a chance, even people don't ask me, still I propagate this idea, because someday this idea will definitely see the light of the day. So till the time it happens, I will continue talking about it, because I think this idea has merit.
No, I think it's a great idea, and the consequences that you outlined are absolutely, I completely agree with them. It's something that we'd be very happy to take up, and we'll also take up not only as GRIP, but I'll also propose this to the Association of Bond Platforms and see if we can take it up as an association as well. But it makes absolute sense. Whatever we can do to protect retail investors' interest, especially principal, I think makes sense to us to do, and it'll help the development of the industry. Just on covenants, there was recently a bond which, as you said, breached the covenant by just a margin, right? They had to meet a certain amount of equity raise, but it happened slightly less than that. And I think the strength of the regulation is that it immediately had to trigger corrective action. So for people who are listening in and don't know what a covenant is, it's basically certain conditions that an issuer has to meet. These are pre-decided conditions. For example, Kishore talked about the importance of capital adequacy. So an issuer has to meet a certain amount of capital adequacy throughout the bond period. And if that drops, then the issuer has to even prepay the bond to the investors, and that obviously acts as a protection mechanism. And we actually saw this happen. So I think some of these protection mechanisms, the disclosure around it, obviously have become very powerful. Kishore, coming back to, we now know what to do, what to look for in a bond. UGRO recently declared its Q2 results. Obviously they are, very interesting. Congratulations on it. But as you would love to for you to walk through some of those highlights, and especially highlight some of the things around capital adequacy that we just talked about, how important they are.
So thank you, Nikhil. So we have declared our results yesterday. In fact, we have just finished before this call our investor call. So the quarter has been really good for us. The journey has been so far very fascinating. So as far as I will talk about capital, I will talk about disbursement, I will talk. So I will not take much of the time, but still I will try to cover as much as possible. So as far as our capital journey is concerned, it is quite unique. So many of you may not know that there is no concept of SPAC in India. SPAC only happens in US, but we are technically India's first and only SPAC, because we started as a listed NBFC before starting our business. So this has never happened before us and never happened after us. The other unique thing about us is that we started with almost 955 crore of capital. Normally in India, and our promoter diluted himself to 3% on day one. Normally in India, it does not happen like this. Normally, promoters come up with a small check as per their capacity. They build an institution for 10 years, 15 years. They keep on accruing their profits. And when they get a desired level of valuation, which is subjective to each individual, they start diluting slowly. But we started with a capital of 1000 crore straight, because we from day one our promoter was very clear that he wants to create an institution of size, and he does not have time for 15 years to just to get his personal benefit, so that he can create in some amount of capital out of profit accrue and then dilute slowly. That will take much longer time to create an institution of size, and he has always had the ambition to create India's largest MSME platform. So it was not possible without that. So on day one we created a listed platform and listed entity. Listed entity we raised 955 crore. The second thing is look at the quality of investors. So TPG, PAG, Samina, and ADV. These were the four large investors who contributed almost 80% of the equity. Then with this capital we started. Then we have seen DHFL ILFS issue. Then we have seen COVID 1, COVID 2. We continue to grow. Last year we raised again 340 crores, and one of the investor was IFU, which is Denmark government sovereign arm. And many of you are not exposed to this environment, that how DFIs work. DFIs work in a very different dimension, whether it is debt or equity. We have 8 DFIs as lender on our balance sheet, and we have 1 DFI as an equity investor. Even in debt, they do diligence for 1 to 2 years time. It is not like taking a debt in India where you go and put a proposal, some screening happens, and after some time, 3 months, 6 months, the kind of detail exercise they do is humongous. In India, I have never seen an equity shareholder doing potential equity holder doing this kind of diligence, which an DFI does. But we have 8 DFIs, and one on the debt side we have one on a balance sheet as a shareholder. So IFU came up with a check of 240 crore last year, and we raised 100 crore more from domestic institution, and we raised 340 crore. This year again we raise equity, which is a unique structure of CCD plus warrant, where total quantum exercise is 1265 crore, out of which we are in money for 510 crore. Balance 700 crore warrant will convert next year. Here again very reputed institutions have come in, like Samina Capital, with an existing investor. They have put in 500 crore. They are investor with us for 6 years, and now they are putting in fresh money which is a testament of their faith in our organization, our governance, our processes, methods, and our future plans. Argents is another fund of Singapore which they invested 200 crores. Then host of family offices. So starting from Atul Nisar's family office who are used to own Hexaware, Mankind Pharma, then Ranjan Pai's family office, Patni family office, about 100 odd family offices, some of the largest family offices, Mr. Jain's family office, all they put in money, and we have raised 1265 crore. As of now, we are sitting on 25% capital adequacy. There is hardly any tier 2. Tier 1 capital is about almost entire thing is tier 1, and tier 2 capital is roughly around 30 odd crores. So as we speak, our net worth is close to 1,950 crore. On a fully converted and some profit adding, we will cross 3,000 crore when the next year this conversion happens. So this is on the equity side. On the portfolio side, since COVID happened, we started growing rapidly. Everyone started slowing down during COVID. We in fact increased our infrastructure multifold during that period. In 2022 we were at 3,000 crore AUM. In 2024 we were at 6,000. We were at 2021 we were at 3,000 crore AUM. With 2022 we are at 6,000 crore. Now we are at 10,000 crore AUM. The growth will continue. We have enough capital, and clearly gives us runway for at least 2 years. Keeping in mind that we would love to be in the capital adequacy range of 18 to 20%. So it gives us runway for 2 years, and then again, if needed, we will look for fresh equity. So AUM growth is robust in the segments. We don't want to diverge from our MSME strategy and the segment we are. We will continue to serve the segment where we are. We are not adding any new sector per se. Some of the subsectors we keep on checking the health of them and keep on adding or removing based on their performances. As far as financial performance is concerned, we were 10 crore PAT in 2022, we were 40 crore PAT in 2023, we were 120 crore PAT in 2024, and in first half we are closer to 66 crore, which is showing that not only it is not a mindless growth, we are growing with all cautions, and it is a profitable growth. And also on asset quality, if you look at our asset quality, our stage 1 asset has remained closer to 94% despite doing secured, unsecured, small ticket loans for almost last 2 years. Our NPA, gross NPA is hovered around 2%, and net NPA around 1.2 to 1.3%. So we think we are in the right path in all parameters. Our cost to income ratio was high when we were building up big time during the COVID. At one point of time, our cost to income ratio was 73%. The previous year it was 64. Last year it was 54%. And this quarter, despite adding 100 branches in the first H1, our cost to income ratio is 53%. So operating leverage is kicking in. So all in all, we think that we are on the right track, and the result of all this hard effort which we are putting in the company will be visible in next 6 quarters time. So by 2026, so we should be among the top quartile on all the parameters, whether it is AUM, profitability, ROA, ROEs, etc. So this is in brief. I can talk for hours, but we have constraint of time, so I would pause here.
It's incredible again, and congratulations. I think not just it's what's incredible is it's not just one parameter, right? It's not just AUM, but I think it's AUM combined with cost income ratio. It's combined with how you have thought about equity, capital adequacy, focus on the right fundamental blocks. I think in the interest of time, I'll take some questions from the audience, but there is I can't leave without asking you some questions on the industry, right? Before we go there, and lots of things have happened. So, very quick thoughts on the recent RBI notification that has impacted 4 NBFCs. There's been a temporary ban on these NBFCs lending out more money. What do you see that as a result of, and does it impact UGRO? And your thoughts on any actions by RBI on the interest rates and what it may mean for bond investors looking to invest now?
Well, we have seen regulatory actions for some time now. First, we have seen two entities were banned in the month of March when they were asked to cease and desist in certain segments. And then now four entities have come into the scanner and they've been asked to cease and desist. Personally, I am not in for these actions because I think they should be given some some guidance by the honorable authorities to make a course correction, and if they fail to do it, then these actions would happen. So they should be given a fair hearing and fair timeline to course correct, rather than putting these measures which impacts a lot of things, which impacts the companies, their equity investors, their debt investors, their employees. But however, having said that, I think RBI never does anything without data. So what we would know from sitting from our AC rooms, RBI would know much more than. So RBI never takes arbitrary decisions. I am very sure about it, that RBI, whenever RBI has taken decisions, it is well thought through. After much deliberation they take, and they don't like take this decision in a hashed or arbitrary manner. So they must have seen some data, some anomaly which is worth taking these decisions. Hence they have taken this decision. So I am not at all I never question the decisions of RBI on these fronts, because it is the greed and the processes and the some of the things practices which forces RBI to take these kinds of decisions. Having said that, I don't think that this is the time to panic. I don't think that any bondholder would lose any money, though I am not representative of these four entities. I have no correlations, because what will happen eventually, these entities will again come back. It is a temporary cease to desist order, like in case of IFL, like in case of JM. I am presuming that once they do the corrections and they go to RBI and submit their compliances, RBI will again allow them to continue with their businesses. Till the time they will have some hardship, there will be a lot of noise around them. But to be on in a selfish, if you look at a very selfish way, there is no risk on bond holders until they are very long. And these entities, I don't think that there are 7-year, 10-year maturity bonds. So I don't think that if the bonds are maturing in the next 6 months, 8 months, 1 year, 2 years time, there is any risk. Because now what will happen, that they will have more inflows and no outflows, because business will be not there. So whatever collection they will have, they will utilize only towards making repayments to lenders, including the bondholders. So I don't think that in any of these four entities risk of default is visible. I personally don't think so. Having said that, people should be cautious while charging interest, where RBI is taking a very harsh view. So whoever is charging, now there is no definition of what is fair interest and what is unfair interest. Today I got a very interesting analogy which I don't agree with, that if a company is making 4% ROE, it is a fair interest. Now, how do you 4% ROE? The company has 5 products. In one product, you are charging 40%, 50%, and in one product, you are charging 10%. Then you can't say that my ROA is below 4%, so I am in fair practice. It is a fair practice. So, what I will think, and I strongly believe that here the regulators should come out with some broad guideline on interest rate on various segments. That they should suggest that based on individual entities, this should be the maximum cap where the interest should be charged. And if the entities are abiding by that, then they should be left with their own discretion. So this is number one. But number two is that in terms of fair practices rather than interest rate, there are a lot of things which are going around, and RBI does not like it at all. So there are entities where thousands and thousands of customer complaints are going unaddressed on a monthly basis. So RBI never appreciates that. So every entity, whether it is those who have been named this time, or some of them may get named sometime after that, every entity need to be a little careful on compliances, need to be very careful on grievances, customer complaints, and then very fair in terms of charging interest, foreclosure charges, etc., based on their risk appetite. And they should, and perception plays an important role. So they should appear to be fair. Now there is no prescription that what is fair and fair, so you should appear to be fair.
That's a good way of putting it. Um, Maybe Kishore, last question before we sign up for the day on the interest rates. And I'm asking this question because when you and I were chatting offline, we talked about how in some ways the bond market is at the lowest possible price point, and we are all seeing some signs where it may change. How are you? RBI obviously has not given any indication. The US Fed has reduced rates. How are you seeing that play out, and what would be your advice to people who are looking to invest in bonds currently?
Look, all of us who are in the industry are more or less on the unanimously we feel the same way. Though some of the retail bondholders don't pick cycles because it is not their full-time job. They it is just their surplus money they invest. So they don't track the market this way, the way we track it. Uh, in all probability, interest rate cycle has picked up. We are not going expensive compared to what it is now in terms of interest rates. So interest rates have definitely picked up across the globe. If you look at, and it is a very interesting time. In my lifetime, I have never seen that UK's inflation is more than India. Have you ever? It was unheard of.
Yeah, no,
9.5% interest rate in UK. If you believe me or not, UK housing loan interest rates are same as that of India
wow.
as we speak.
Those are
But
things you don't build into financial models.
yeah. So now, what has happened in last 3 4 months globally? The interest inflation, which was very subdued in Europe, in rest of the Asia, it was moderate. It has showing signs of cooling off across the world, irrespective of the two wars that are going on. Crude is cooling down. Overall, so Fed has promised. Fed has already done 50 basis point reduction. They promised two more, so 100 basis point this year. Next year they have not ever given any guidance. ECB has done three rate cuts already. So rate cut is around the corner. So whether it will happen in December monetary policy or February monetary policy, we don't know. But certainly it is not going to go up. It is going to go down from here, which means that those investors who are sitting on liquidity, it is the right best time for them to lock their money in debt market for a longer tenor. Don't look at shorter tenor period because you will be shortchanged if you look at short tenor period just because your risk appetite says that buy 6 months bond or 8 months bond, because today the bond which you are buying at 10%, 6 months down the line the same company, same risk, same bond you will have to buy at 9%. So this is the time to lock your money in debt, lock long as long as your risk appetite and the perception about the company permits you. But this is time to go long on bond market. Avoid all other instruments which are available, and because if you want to take advantage of down cycle of the interest rate, then this is the best time.
Yeah, perfect. No, I don't think that message could be delivered better. And I think there are a few people who have put on messages to really appreciate how you have communicated the transparency and the simplicity of that. I do want to tell everyone that we've had the UGRO Capital bond on our platform for now over a year, different issuances. UGRO is now coming out with a new bond issuance, and we're very excited to be bringing it on the platform soon. I hope you will explore it, look at the metrics that Kishore talked about, and if it obviously meets your requirements, then invest. To Kishore's point, we are also trying to bring on our platform longer term instruments. We are bringing different tenure instruments of the same bond to give you the choice of whether you want to invest in a shorter term or a longer term, as well as bringing a basket of bonds which are longer term with principal payout only in the end, so that you get the full benefit of locking in interest now and holding it for a longer period of time to get better absolute returns. Um, we hope to keep working with you, Kishore, and bringing such products, bringing bonds out on the platform. We've been, we'd love to support you, and I think it's a very comfortable mutual relationship. Look forward to working with you more, and thank you for taking time on a Wednesday, one day after your results, to do this session. We really appreciate it, and wishing all of you a great night.
Thank you, Nikhil. Thank you, everyone. Wishing you all a very happy Diwali in advance. May the new year bring all the prosperity to you and a lot of happiness to all of you. Thank you. Thank you.
Thanks, Kishore. Thank you so much. Kishore, Kishore, if you can just stay on for 1 minute.
Yeah, sure.
You'll see a small tab on the left hand side, which is just uploading the remaining video.